Good morning, dear students. How are we all? Good morning, everyone.
Good morning, sir. Fine, sir. Thank you.
Good morning. Good morning. So I see a lot of students waiting eagerly on this Monday morning to get an understanding and learn about something called as advanced capital budgeting. This is chapter number 3 from the subject of advanced financial management at CA final course. Now, to have a brief recap of what we have done in CA Inter. In CA Inter, we had a topic called as investment decisions. Do we remember it, guys? We had a topic of investment decisions.
Yes, sir.
So, can you just recall certain nomenclature from there? Certain concepts that you have learned in Inter level?
IRR of the project.
IRR, okay, perfect. So
NPV.
Mm-hmm. So we have learned how to calculate IRR. We have learned how to calculate NPV. Anything else that you can recall? Just IRR, or have you done something else also? IRR, NPV, any specific? If I talk of, okay, let me just do one thing. Let me frame it the other way around. What do you mean by net present value? How do we calculate the net present value? Of course, this is what is a prerequisite when we are going for this final course, okay?
Yes, sir. Inflow, cash inflow, then cash outflow. So, see, what we will do in the project, the initial outflow will be there. What is the inflow? Then when the initial inflow is less than the outflow,
okay,
then the positive will be there. Or negative means there is a negative NPV.
Okay. So basically, when we did some calculations with regards to NPV, it was a very simple aspect, wherein what we did was we computed net present value as simply present value of cash inflows, right?
Less present value of cash outflow.
Correct. Less present value of cash outflows. Okay. So now just to recap, we calculate the present value by using the PV factor and all. I'm not going into that part because that you would have already learned a lot about. But my idea is, how do you calculate this PV? I mean, what is the rate that you use for calculating the present value? I'm just trying to get certain basic things clear before we proceed ahead, right?
Yeah, by way of discounting the interest rate.
By way of discounting the interest rate, is it? Anyone else? What is the rate at which we used to discount our cash flows?
The inflation rate at which it is decreasing the value of rupee.
Inflation rate, is it? Yes, Guram has said it correctly. We take both these present values. Not by inflation or some interest rate, but we discount it at something called as cost of capital. Right? Because the simple funda is, have a business entity which raises money from the market, and that money is invested into projects, right? So are we going to get this money from the market free of cost? Are we going to get this money from the market free of cost, or do we need to incur some cost for that?
We need to incur some cost for
We
that,
need to
sir.
incur some cost. Definitely, we need to incur some amount of cost, right? So you may raise the money by way of debt. You may raise the money by way of debt. You may raise the money by way of equity, by way of preference share, and a lot of different categories. Now, let's say debt is going to cost you 8%, equity is going to cost you 12%, preference share is going to cost you 10%. So what should be the rate at which I should discount? I should evaluate these projects. Should it be 8, 12, or 10? Yeah. What should be the rate at which we discount the project, discount the cash flows of the project? Is it at 8%? Is it at 12%? Is it at 10%?
Sir, it will be on 10% because at that rate we will get the preference share.
But I have raised money from all the different sources.
Then the weighted average cost of capital. Debt.
Then I'll take the weighted average cost of capital, right? So we have already learned how to calculate weighted average cost of capital at inter level. So that weighted average cost of capital, let's say for all of them, turns out to be 11%. So I'm talking like whatever money I have raised, that is costing me 11%. Whatever money I have raised, that is costing me 11%. And the money that I have put into the projects, that has actually come from this holistic money that I have raised. So when I'm investing money over here into the projects, I'll be definitely expecting a bare minimum return of 11%. And therefore, projects are also going to be discounted at 11% only. Okay. So just keep that in mind that whatever cash flows we have, we are definitely going to discount them. But when we're talking of discounting them, we are essentially talking of, using the cost of capital to get it discounted. Right. So we're going to use the cost of capital to get the projects discounted. And when we do that, it's called as an NPV. Now, we have also learned something called as IRR. These are the two main concepts that we have learned. IRR is basically, that rate. That's the rate of return generated by project. Okay. So we're talking of rate of return that is going to be generated by the project. Like, as I said, we are putting money over here, which is costing us 11%. Isn't the project going to generate some return for me? And as a common sense, if I ask you, which project are you going to choose? The projects which are going to give you returns, exceeding 11% or less than 11%? Which projects are you going to choose? The projects which are giving you returns more than 11% or less than 11%? Of course, more than 11%, right? We will definitely be expecting requiring the project which will be giving us return more than 11%. It should be exceeding 11%. Right, guys? So the project should be giving us returns in excess of the 11% benchmark. Whatever is the return that the project is generating is what we call as the IRR. And one more property that we would have learned is that if we discount cash flows at IRR, then can you tell me what is the NPV going to be? If we discount the cash flows at IRR,
NPV will be 0, sir.
NPV will be 0, right? Because at IRR, PV of inflows is going to be equal to PV of outflows. Right? So PV of inflows is going to be equal to PV of outflows. Right? So that's what we have broadly covered in our inter level. Now, when we are at final level, we are definitely going to take the discussion further. Right? So what are we really going to discuss in this subject for the final level? Let's have a brief understanding of that. For that, if you can just recall when we are calculating the NPV, what was the process? We used to first calculate, while calculating this NPV, we used to have like, first step was to calculate cash flow after tax. And then second step was to take the present value of cash flows. And then finally we used to get the NPV. Now remember, when we are talking of calculating a CFAT or a cash flow after tax, did you ever encounter any question where the cash flows were, adjusted for inflation or something like that? Have you ever done anything at that interlevel? Because this is more something which is practical. So when you have cash flow after tax, we have generally not given any consideration for the inflation part, right? Because we were ignorant about that at that particular level, that there could be something, which could be like inflation. So because CFAT comes from what? From where does the CFAT come from? It comes from ultimately the sales, all your cost, all your overheads cost, labor cost, and all these numbers are definitely subject to inflation, right? All these numbers are subject to inflation. So the cash flows are definitely subject to inflation, and we are definitely going to consider that in our final level discussion, because of course this is more practical, that we need to check what is the inflation ongoing in the market, and we need to choose a particular method on that basis. So first thing is impact of inflation on capital budgeting, right? That is what we are going to discuss. Okay. So how inflation is going to have an impact on the capital budgeting decisions. That's the first part that we are going to do. Second part that we are going to cover up in final level is we are going to evaluate risks in capital projects. Now, when you're making an investment into any project, it's not something which is devoid of any risk. It's definitely having some amount of risk, right? So how do we measure that risk? Because unless and until we are going to measure the risk, we will not be able to understand how to manage that particular risk, right? So we are going to have certain techniques by which we will be able to measure the risk that we have in a capital project. So broadly speaking, there are three set of techniques that we are going to use. One is called as a set of statistical tool. Okay. So statistical tools, we will be using statistical tools like, if you could remember, what is the probability, right? Correct, guys? We're aware of what's a probability, right? Just let me know if you remember something called as variance. Do you recall something called as variance from your foundation days? Yeah.
Yeah, variance and coefficient of variance,
standard deviation,
deviation,
right? Expected value. So those things are going to be now applied in the advanced capital budgeting decisions, right? So in statistical tools, we are going to learn something called as probability. We're going to discuss something called as variance. We'll be also discussing the standard deviation and coefficient of deviation also. Also, these are certain techniques that we are going to use. Second is, there are certain conventional techniques. Right? The conventional techniques which we are going to use, which have been, prudently used since long. We're going to do something called as risk-adjusted discount rate. Right? The risk-adjusted discount rate. And we're also going to learn some concept called as certainty equivalent. Techniques, we will take a note of them in the meantime. what are these techniques essentially. Apart from that, there are certain other techniques that we are going to use, which will include something called as sensitivity analysis, wherein we are going to see which of the variables are more sensitive. We're going to carry out something called as a scenario analysis. We'll be doing something called as decision tree. Okay. And also, we'll be evaluating at different methods of arriving at, or different, viewpoints when it comes to calculating the NPV. That's called a simulation. So we are going to discuss all of these advanced techniques. And the third important part that we have in this chapter is to calculate something called as adjusted present value. Okay, what's this adjusted present value? Do we remember the topic of capital structure from interface? Can we recall the topic of capital structure? Yeah. At CA Inter, we had a topic called as capital structure. Do you remember? Yes. Okay. In that we set, we had but two school of thoughts when it comes to the capital structure.
Modigliani-Miller approach.
Yeah, one of
Relevance
them was
approach and
Modigliani-Miller.
irrelevance approach.
But broadly, we would have classified that into two. What is it? It's called as a theory of relevance and theory of irrelevance. Correct? Do we recall that? So we had something called as theory of relevance, theory of irrelevance. So they were all talking about whether capital structure is relevant or not relevant for the valuation of a company. In that, we had something called as Modigliani-Miller with taxes approach. I hope you can recall that we had something called as value of a levered firm, value of unlevered, plus debt into tax rate. Do you recall something like this?
Yes, sir.
Yeah. So taking a cue from that, we are also going to calculate this adjusted present value, wherein if you would like to evaluate the present value of the project or NPV of the project, taking into account, we're going to look at present value of a project by taking into consideration the aspect that if the project is funded by debt, then what happens to the present value? If the project is funded by debt, what happens to the present value? That is what we are going to check. Okay. Makes sense? So this is what the agenda that we have with regards to the the entire advanced capital budgeting. Apart from that, we have certain theory aspects also, certain theoretical aspects also. That is also something that we are going to cover. Okay. So essentially, we are first targeting this portion, which is the impact of inflation. We are first targeting this portion of impact of inflation. There are certain, this is quantitative aspect. There are sometimes, qualitative aspects also. Right? So qualitative aspect could be whenever there are changes in technology, then whatever capital decision you would be taking, that is of course subject to this risk that there is some change in technology. There are changes in the government policy. So our techniques may totally go in a different direction altogether, right? Okay. So we are going to first target this aspect. What is the impact of inflation on capital budgeting? Okay. Now, let me just put it first way around. Impact of inflation with numericals. See, suppose we are talking of sales, right? So we are talking of essentially first the impact of capital budgeting, impact of inflation, sorry. Impact of inflation on capital budgeting. Now, if I say that selling price is 10 rupee, and then we have year, units, and let's say sales. Now, we have like first year, second year, third year, fourth year. So we have 4 years data. Let's say first year we're expecting to sell 1,000 units. Second year we're expecting to sell 1,200 units. Third year 1,500 units, and fourth year let's say 2,000 units. So what will be the value of sales in such situation? If I say sale price is 10 rupee, of course the sales value is going to be, first year it's going to be 10,000, second year 12,000, third year 15,000, and then 20,000. Right? Now these are the sales number under an assumption that there is no inflation. If I give you data that inflation rate is 5% per annum, do you expect the sales value to remain same, or do you expect the sale values to be changing? Are the sales values going to remain same, or are they going to change? Of course, they're going to change, sir. Right? Demand and all such aspect. But yes, the sale price per unit, year 1, 2, 3, 4. Units are going to remain same, 1,000, 1,200, 1,500, 2,000. What is the value of sale price per unit? Tell me. If I say that this is the 10 rupee that we have, this is price in year 0. This is price in year 0. So what will be the sale price per unit in the first year, guys? If there is a 5% inflation.
First year 10.5.
10,500.
No, sale price. I'm talking of sale price.
I think first year it should be
10.5.
First year it will be 10.5 because there's a
10.5
inflation, right? One second, I'll just get the calculator over here. Okay, so first year we have 10.5. Second year, again there's going to be a hike in it. So 10.5 into 1.05. So sale price is going to be 11.03. I'm just confining my calculations to 2 digits, right? 11.03. Third year, it's going to be 11.03 into 1.05 again, which is 11.58, right? And then 11.58 into 1.05, which is 12.159. Right? So these are the sale price. So if I look at sales at future prices, that would be 1,000 into 10.5, which will be 10,500. 11.03 into 1,200, that will be 13,236. 11.58 into 1,500, that's 17,370, and then 12.16 into 2,000, 24,320. Okay, so these are the sales at future prices. Okay, now my question is, can I discount this cash flows and these cash flows at the same rate. Can I discount both these cash flows at the same rate?
No, sir.
No. Okay. So these cash flows, the initial set of cash flows that we had, which is at current prices, these are called as the real cash flows. They're called as the real cash flows. And the prices which are adjusted for inflation are called as nominal cash flows. Okay. So we have one set of cash flows is called as a real cash flow, other is called as a nominal cash flow. Real cash flow is basically the cash flows at current price level, right? Without any inflation. And nominal cash flows are with inflation. So real cash flows, we need to understand that they are going to be discounted. Real cash flows are going to be discounted at real rate of return. And the nominal cash flows are going to be discounted at nominal rate of return. Now, can you tell me, out of these two rates, we're talking of one is a real rate and another is a nominal rate. Out of these two rates, real rate and nominal rate, which one is going to be a higher number?
The higher number will be the nominal rate of
flows. The nominal rate is going to be higher because since your cash flows are higher because of inflation, I need to add that inflation premium. I need to add that inflation premium to that. Right. So there has to be some sort of relation between a real rate and between a and the nominal rate, right? So simple relation that we can put up over here is 1 plus real rate of return. You compound it with 1 plus inflation. That is going to give you 1 plus nominal rate. 1 plus real rate, when you compound it with 1 plus inflation, that's actually working like a nominal rate for us. 1 plus nominal. So, for example, if I say a real rate, okay, a real rate is 5%. Inflation is, let's say, 6%. Can you calculate what's the nominal rate, guys? Calculate the nominal rate. Can someone give me the answer for nominal rate? You have the formula in front of you. You have the formula in front of you. The real rate is 5%. Inflation is 6%.
1.113, sir.
1.113.
1.113. Sorry. No, sir. It's actually 11.13, sir.
11.13. Okay. Let me just put up this formula. So this is going to be calculated as 1 plus real rate. So 1 plus real rate is basically 1 plus 5% into 1 plus inflation, which is 6%, is equal to 1 plus the nominal rate. Now 1 plus 5% is 1.05 into 1.06 is equal to 1 plus nominal rate, right? So 1.05 into 1.06, that's 1.113 is equal to 1 plus nominal rate, right? So nominal rate will be how much? 1.113 minus 1. which is 0.113,
11.3%.
is 11.3%. Nominal rate is 0.113, which is 11.3%. Right, so nominal rate is 11.3%. Correct. So we can observe that when we are including the impact of inflation, the nominal rate is obviously substantially a higher number, right? So logic is simple that your 1 rupee is going to become 1.05. But that's not what we need. We need additional 6% on that. So when you need additional 6% on that, you just multiply. I mean, 1.05 gets multiplied by 1.06. Right? So the total return that you're likely to get, that you need, is 11.3%. Okay, let me just put up one more case in front of you. Let us say I tell you that nominal rate is 15%. Inflation is, let's say, 8%. Can you tell me what is the real rate? Can you calculate the real rate I'm given? Yeah. Calculate the real rate.
10.64% or 6.5.
10.64. Is it 10.64?
6.5.
Sir, it is 6.4, sir, 6.4%.
6.4%. We'll use the
Yes,
same
sir.
logic over here. 1 plus real rate into 1 plus 8% will be equal to 1 plus 15%. So essentially 1 plus real rate
6.
is
Yeah.
1.15 divided by 1.08. So 1 plus real rate is 1.15 divided by 1.08, which is 1.0648. So real rate is
6.48%.
6.48%. Perfect. 6.48%. True. Okay. Clear, guys?
Yes, sir.
Okay. Now, with that, let us just try to solve the first question probably. 1 second. The first question from the assignment sheet. I'll just bring that assignment sheet to the screen. Wait a moment. Okay, here we have the first assignment. The first question. Are you able to see the screen?
Yes, sir.
Yes, sir.
I hope you all have access to this file. If not, for the time being, you can just take a screenshot of it. Okay, anyways, I'll just take it and post it in our file also.
It is available in portal also, sir.
It's available. That's fine.
Bandhuji, this is Saransh is available.
Yeah. No, not
Oh.
Saransh. I'm talking of the assignment, whether they have
Okay.
got it.
No,
or not.
assignment is available.
Yeah.
Assignment, everything is available. No problem.
Mm-hmm. Okay. So here we have this question, which will give us an understanding of what are we really talking of when it comes to inflation adjustment. Okay. Now, we have to determine the NPV. Initial outlay of the project is 40,000. Annual revenue without inflation is 30,000. Okay, so without inflation, it is 30,000. So can you tell me this cash flow represents a real cash flow or nominal cash flow?
Real cash flow.
It's a real cash flow, sir.
Annual cost excluding the depreciation without inflation is again 10,000. Again, these are real cash flows.
Real.
Useful life is 4 years. Salvage value is nil. Tax rate is 50%. Cost of capital, including inflation premium of 10%, is 12%. Now, what is this 12%? Is it nominal rate or is it real rate?
It's nominal rate, sir, because it includes the inflation premium.
Sorry?
Yeah, it's a nominal rate, sir, because it including inflation rate premium.
It including the inflation rate premium. Okay, perfect. So now, when I want to discount this, when I want to take the NPV of this, how am I supposed to take? Should I add any inflation part to these cash flows? Yes or no?
Find the real rate first and then do that.
Do I
Yeah.
need to adjust this revenue and the cost? Yes or no?
Yes, sir. Either we need to convert that revenues into real we need to change it, sir. Or either we have to change the cost of
Correct.
capital into real
Correct.
cost of capital, or in the cash flow into the
Correct. Perfect.
nominal cash flows.
So these are the real cash flows. So I need to convert this to real. Or if I want to use the nominal rate, I can simply convert these cash flows to nominal cash flows, and I can use this 12% discount. Correct? So let us do both ways to understand what are the implications of that. So let's try to adjust our cash flows to make them nominal cash flows, right? So we're going to discount our cash flows at nominal rate. So I need to calculate the nominal cash flows. Okay. Now, when we're talking of nominal cash flows, I need to calculate what is the inflation adjusted revenue and what is the inflation adjusted cost also, right? So I need to adjust both cash flows. I mean, that revenue as well as the the cost. Okay. Now, we have the nominal rate 12%. Let's try to convert our cash flows to nominal numbers first. Okay. So we know how to calculate the CFAT, right? So we'll say calculation of cash flow after tax. And we're talking of nominal. Calculation of cash flow after tax, nominal.
Nominal and real.
So first, let us talk of revenue. Revenue in real terms, it is given in the question as 30,000, right? less cost in real terms. Right? So cost in real terms, that's going to be 10,000, right? Then we have less depreciation. Right? So less depreciation. This is going to be, of course, 10,000 because we have the initial outlay as 40,000. Salvage is nil and its life is 4 years, right? So we can say depreciation is computed as 40,000 divided by 4. So this is going to give us profit before tax. And of course, this is also in real terms. Profit before tax is also in real terms, which is 10,000. Okay. From that, we are going to subtract the taxes. So tax is, 50%. So we subtract 5,000. Then we have profit after tax, which is 5,000, right? From this, we get.
We need to add the depreciation.
Add the depreciation. Perfect. So adding the depreciation of 10,000, which will give us the cash flow after tax to be 15, right? Now, this CFAT is what we have got it in real terms. How do we get the nominal CFAT now?
We have to add the inflation rate.
Inflation rate, perfect. So here, calculation and CFAT, we are talking of nominal CFAT. Right? So here 1, 2, 3, 4. So first year with inflation, it's going to be what? 15,000 into 1.1.
It's 16,500.
16,500. Second year, it will be 16,500 into 1.1.
18,150.
18,150. Then 18,150. Again, adjust for 10% inflation.
19,965.
19,965. 19,965 into 1.1.
21,962.
21,962. That's your nominal CFAT. Now, can we calculate the NPV of this? Yes or no?
Yes, sir.
Since we have the CFAT, can we calculate the NPV of it now? Yes. So nominal
Yes, sir.
CFAT we have. Then we simply say present value factor at, what's the present value factor? Nominal rate 12%, right?
12%.
And then you take the PV. So can you guys just calculate and tell me the PV over here? Remember, we are using nominal cash flows and discounting it at nominal rate. To calculate the NPV for me, guys. Yeah, give me the NPV, guys.
That is 57,368.
57,000.
Sorry.
Sir, 66,000, sir. It's total.
Okay. Total of this is
66,000.
66.
Yes, sir.
So first take down the PV factors at 12%. 1 divided by 1.12. So take it as 0.8929. Then 0.7972.
Then
Then
color
0.7118. 0.6355. Right. So when you take the PV of all the cash flows, the PV should be 57,371.
82.
Okay, something over here and there, that's okay because of the rounding up error, that's fine. So we get this PV as 57,370. Now, of course, from this, we are going to subtract the initial cost, which is 40,000. So your NPV is 17,370. Okay. So what did we do? We just discounted the cash flows, nominal cash flows at nominal rate. Are we clear with this? Yes, everyone?
Yes, sir.
Are we clear with this? Okay. Do you think that in our calculation, there is some mistake that we have done? I'm talking of nominal CFAT calculation. The nominal CFAT calculation, there's some mistake that we have done, guys. Can you tell me what is that? While calculating the nominal CFAT, we have done some mistake. Anyone can identify? The nominal CFAT, I'm just giving you an idea that the
Sir,
nominal
is it?
CFAT that we have computed, that's incorrect. Practically, this is incorrect.
Yes, sir. Because it every year we include inflation rate like that.
Every year? Sorry?
Is it that because of depreciation?
What sort of adjustment do we need because of depreciation? Yeah? Okay. Any idea? Or shall I take it up?
Because like depreciation does not affect the inflation,
Yes.
right? Like
Depreciation is not going to be impacted by inflation. In fact, not depreciation, but tax saving on depreciation is not going to be impacted by depreciation. Let me just show you something. See, how did we calculate the CFAT? We took the revenue. From that, we subtracted the cost. From that, we subtracted the depreciation. And this entire thing was made after tax by deducting tax into 1 minus T and then adding back depreciation. So revenue minus cost minus depreciation into 1 minus T plus depreciation, right? Now let me just open it up. This is revenue minus cost into 1 minus T minus depreciation into 1 minus T plus depreciation. I just opened it up. So this 1 minus T was first multiplied by R minus C and then depreciation with 1 minus T. And then this depreciation was written as it is. Further, I can definitely say that it's R minus C into 1 minus T, right? And let me just open it up. Minus depreciation plus depreciation into tax plus depreciation. So can I say minus depreciation plus depreciation gets subtracted? And this we have R minus C, revenue minus cost into 1 minus T plus depreciation into tax. So this plus depreciation into tax, this is essentially nothing but tax savings due to depreciation. Tax savings due to depreciation. So do you mean to say that as inflation rises, income tax is going to provide me more tax saving due to depreciation? Is it going to happen? That due to inflation, the income tax is going to provide us a higher degree of depreciation or a higher tax saving due to depreciation? Is it going to be a case? No, right? Depreciation, the tax saving on depreciation is a fixed amount. It's not going to change with inflation. So when we say that CFAT is revenue minus cost into 1 minus T plus depreciation into tax. Okay. So we can say this revenue and cost are impacted by inflation. Right? So these are impacted by inflation because these numbers change as the inflation changes. Your revenue changes because of changes in inflation. Your other cost also changes. But this particular portion, this is having no impact of inflation. So the calculation that we did, which is this nominal CFAT, this is essentially technically incorrect. Because here, what we have done is, we have adjusted for inflation this entire aspect. This entire aspect was adjusted for inflation. Okay, so CFAT, this entire aspect was actually adjusted for inflation. This entire thing is, was going to be adjusted by the inflation. Essentially, what we should do is only this portion should be adjusted for inflation. This portion should be left as a base. Correct, guys? Did we get it?
Yes, sir.
Are we getting the logic, right? So I need to revise this nominal cash flows. The nominal CFAT is not what we have computed over here. We need to revise it by stating that revenue minus cost into 1 minus T, that is going to be impacted by the inflation. I mean, that needs to be adjusted for inflation by increasing it every year by 10%. But the tax saving due to depreciation should not be touched at all. Right? So tax saving due to depreciation should not at all be adjusted for any sort of inflation. Correct, guys? So let's recalculate the nominal CFAT, guys. Or we'll talk of the rectified nominal CFAT. Here, then we have the nominal CFAT calculation. We'll show all the calculation, right? So in year one, when we're talking of nominal CFAT, it's going to be revenue minus cost into 1 minus T. So revenue is 30,000. Minus cost is 10,000, right? This into 1 minus T, which is 1 minus 0.5, right? And then plus 10,000 into 0.5. Now, which of these two aspects needs to be adjusted for inflation, guys? The first aspect, right? So this is going to be multiplied by 1.1. So this is going to be equal to what? 20,000 into 0.5, which is 10,000. So that 10,000 needs to be adjusted for inflation, which is 1.1. That's going to be 11,000. plus
5,000.
this will be 16,000. Nominal CFAT will be 16,000. What about nominal CFAT in year 2? Can I say 11,000, which was a part in first year, that 11,000 is going to be adjusted for inflation of 1.1 plus the 5,000, which is the depreciation tax. So this is 11,000 into 1.1
12,100.
plus 5,000, that's 17,100. Right? So per year, so its calculation is what? 11,000, 12,100. So this will be 12,100 into 1.1 plus 5,000. So that will be 12,100 into 1.1, 13,310 plus 5,000. Right? 13,310 plus 5,000, which is 18,310. Then fourth year, it's going to be 13,310 into 1.1 plus 5,000. 13,310 into 1.1, 14,641 plus 5,000. That's equal to 19,641. Now, can you calculate the correct NPV? Can we calculate the correct NPV? By taking the PV factor at 12%, take the PV summation, from that you subtract 40,000 and then you get the NPV. So, can you calculate that?
Yes, sir.
Yeah. So, give me the correct NPV is calculated quickly.
Sir, it
Sir,
will
it's
be 31,051.
How much? 13,000?
13,421.
31,451.
13,421, sir.
13,421. Okay. NPV, right?
NPV, I'm talking about NPV. The total of that 53,421.
No, that's okay. 53,431. Are we getting it? Did we realize what was the thing that we were missing when we were calculating the NPV in the first case? Are we realizing that part, guys? What we were missing in the first case? Yep. Okay, perfect. Now, this is the first thing that we did where we where we calculated the NPV by taking present value of nominal cash flows at nominal rate. Now, of course, we can calculate the present value of real cash flows at real rate. Let's look at that method also, so discounting real cash flows at real rate. Now, for that, I need to first calculate the real rate of return. Right? So, with the given numbers, inflation is 10%, cost of capital, which is the nominal rate 12%. Can you tell me what's the real rate of return over here? Can we calculate the real rate?
This
9.9.
1.20.
It will be like nominal rate of, 1 plus nominal rate 1.12 is equal to 1 plus real rate into 1.1. So therefore,
Yes, sir.
real rate of return is 1.12 divided by
1.1818.
1.1.
That is 1.8. 1.8.
1.8182%, right?
Yes, sir.
Real rate is 1.8182%. It is 1.8182%, right?
Yes, sir.
Now, we need to discount all the cash flows at real rate. So I need the real cash flows. So real cash flows are pretty simple. Whatever we computed in the first year as the CFAT, which is 15,000, that itself is the real cash flow. So I can simply calculate NPV using the real rate of return. So NPV using real rate of return. We already know that CFAT, which was computed by us, which is 15,000, right? So we can talk of year, cash flows, PV factor, and PV. 0, 1. In fact, I can say this is just 1 to 4. In 0th year, we have an investment of 40,000. And in 4 years, it's going to be 15,000. Present value factor at 1.8182%. Give me the NPV over here, guys. Give me the NPV. Take the present value factors at 1.8182%. And of course, this will be a negative number. This will be, remember to take a present value annuity factor here. And then give me the final NPV. Calculate and give me the final NPV, guys.
Sir, it's getting in minus 23,000.
Minus? No. What's the PV factor? It should be present value annuity factor, guys.
Sir, it's a NP of 4,411.
4,411. No.
Sir, 4,110.
Give me this factor. What's the factor that you have written here?
Factor I have.
1.818.
Sir, I have total of 1 divided by 1.018. I don't want to. It's coming 0.9822. Like that, 4 years.
That is for first year. So I need to have an annuity factor here.
Yes, sir.
Which is a cumulative of all 4 years. 1 divided by 1.018182. Okay. We use that memory function. So
Sir,
1,776 is the first year. So M plus, second year M plus, third year M plus, fourth year M plus, right? And then we call the memory recall, which is the PV factor is 3.8246. Because this 15,000 is occurring every year, right? For 4 years. So that 15,000 into 3.8246.
Yes, sir. Now it's coming 17,369.
Into 15,000. So that's 57.
57,369.
Our NPV is 17,000,
369.
right? You can see that this 17,369 was actually equal to NPV, almost same because just the rounding up error. When we use the nominal CFAT in an incorrect way. Can you observe that?
Yes, sir.
Which is obviously it would be the same because you are anyways adjusting the cash flows for the inflation. But practically it is incorrect to say that, entire cash flows will be adjusted for inflation. So we did a rectify. So if you want to calculate the nominal CFAT, it's going to be this way, where you remove the impact of inflation on the depreciation saving. And if it's a real cash flow, it's a really easy game to do that. Perfect, guys. Are we good? Clear? Okay, great. Now, let us take up another question from the handout, which is question number 2. Okay, let's look at this question, guys. XYZ Limited requires 8 lakh for an unit. Useful life of project is 4 years. Salvage value is nil. Depreciation charge is 2 lakh per annum. Expected revenue and costs, which is excluding depreciation, ignoring the inflation, is revenue and cost. Now, what are these cash flows? Real or nominal?
This is real, sir.
That real. So, excluding depreciation, ignoring inflation. So I need to make them inflation adjusted into nominal cash flow. So tax rate is 60%, cost of capital is 10%, including the inflation premium. So in this, we have a inflation premium given to us. Okay. Calculate the NPV of the inflation rate for revenue and cost. Now, one peculiar thing over here is revenue is having a different inflation rate and costs are having a different inflation rate. Right. So over here, we have the cost of capital given to us. So I'm going to do this by nominal to nominal method. Means nominal cash flows will be discounted using nominal rate of return. Okay. I cannot use the real rate of return because I cannot calculate the real rate over here because I just have a nominal rate. Now to get the real rate, I need inflation. Now inflation is having a different set of numbers in each of the years. So I cannot calculate the real rate, and therefore I need to discount. I need to solve this entire question on a basis of real to real basis. Okay, which is real cash flows will be discounted using real rate of return. Now, I just give the outline, and you're supposed to do all the calculation sort of thing. So we talk of like calculation of nominal CFAT. Okay, so calculation of nominal CFAT. So in that, we are going to have two components. Components basically revenue adjusted for inflation. Second is the cost adjusted for inflation. And third is the impact of tax saving of inflation, tax saving of depreciation, sorry. Yeah. So let's see here. Okay. Real revenue inflation. Then we will say nominal revenue. Okay. Then similarly, we are going to say here real cost. And of course, this is excluding the depreciation part. you adjust the inflation, and then nominal cost. Okay. After this, we say year nominal cash flow after tax, which will be nominal revenue minus nominal cost plus depreciation into tax rate. Then what we do is take the present value factor at 12% because inflation rate is 12%. No, sorry, cost of capital is 10%, right? Okay, so present value factor at 10%, and then you take the present value. Okay. Now, so we have here 1, 2, 3, 4. We have the revenues given to us 6 lakh, 7 lakh, 8 lakh, 8 lakh. Inflation in first year it is 10%, second year it is 9%, third year it is 8%, fourth year it is 7%. So nominal revenue will be 6 lakh into 1.1, 6 lakh 60,000. Second year nominal revenue is going to be like 7 lakh into 1.1 and then adjust it for another 9%, right? Then next it will be 8 lakh into first year inflation of 10%, second year inflation of 9%, and third year inflation of 8%. Then you have 8 lakh into 1.1 into 1.09 into 1.08 into 1.07 to adjust for all 4 years of inflation. Same way, you have to get the nominal cost, and then we go for this. Now, calculate the nominal revenue numbers and the nominal cost. Then we'll write down over here. So first you give me these numbers. I mean, first 4 numbers of nominal revenue, then give me the numbers of nominal cost, and then we'll go ahead with the next part. Yeah. So here we have 6 lakh, sorry, 6 lakh 60 is done. 7 lakh into 1.1 into 1.09, which is 8 lakh 39, 300.
At 10, next 10 lakh 35, 936.
Okay. 10 lakh 35, 936.
936.
Okay. Then the last one.
I'm working on it, sir.
Okay, sure.
Sir, it's coming 11 lakh 8,452.
11 lakh 8,452.
Yes,
okay.
sir.
Now, here 1, 2, 3, 4. The real costs are given to us, which is 3 lakh, 4 lakh, 4 lakh, 4 lakh. 4 lakh and 4 lakh. Okay. So what will be the inflation numbers? And inflation numbers are also given to us, which is 12%, 10%, 9%, 8%. Get the nominal cost numbers. They're the nominal numbers, guys. Nominal cost numbers. Okay. So nominal cost numbers are 3,36,000,
3 lakh
4
37,
lakh
92 800,
800,
5 lakh 37
5 lakh
152,
152, 5 lakh 80,124. Okay. Now we have here 1, 2, 3, 4. 6,60,000 is the nominal revenue minus the nominal cost is 3,36,000. Wait a moment. We need to make it after tax. So I cannot just take it directly over here. Rather, what we need to do is this multiplied by tax, right? And then to that we are multiplied by 1 minus tax. And then to that we will add depreciation into tax. So 6,60,000 into 3,36,000 into 1 minus tax rate is, what is the tax rate given?
Sir, tax rate is
60%.
60%.
60%. So this will be 1 minus 0.6 plus what will be the amount of depreciation?
Depreciation is not given here, sir.
So requires 8 lakh. In fact, depreciation they're saying it is 2 lakh per annum.
Yeah, which are we can calculate it because it's given the useful life and salvage value also is nil.
So that's
Then
it. 8 lakh divided by 4, it's just 2 lakh. Right.
Okay.
So 2 lakh into tax rate of 0.6. Okay. Now, what is this number? Nominal CFAT. 6,60,000 minus 3,36,000 into 0.6, sorry, into 0.4 plus 1,20,000. What's the nominal CFAT? 6,60,000 minus 3,36,000 into 0.4 plus 1,20,000. 249,600. Right? First year 249,600. Second year it's going to be 8,39,300 minus 492,800 into 1 minus 0.6 plus 2 lakh into 0.6. The same way you do all the calculations and then take the PV, subtract the cost which is 8 lakh. Then we get the NPV. Yep. So nominal CFAT in second year, how much is it? 2 lakh 58,600. Okay. Third year,
3,19,514.
3,19,514. Okay. Fourth year it is
3,31,329.
3,31,329, whatever. And then you take the PV. Let me know what's the NPV.
And PV would be 1,07,518.
1,07,518. Just check this. Are we getting this approximately? On an approximate basis, you should be getting this number. Let's check, guys. Are we getting this number? The NPV.
Yes, sir. I am getting 1,07,001, sir.
Okay, some numbers here and there, it's okay. That's definitely acceptable because it is subject to rounding up error. Okay, fine. So that's how we got the NPV. I hope we are clear with the concept of adjusting inflation for calculating the NPV, right? Are we all good? Shall we proceed, guys? Okay, let's go for the next aspect now, which is the impact of probability-based discussion now. So let's first discuss this theoretical aspect a bit. So we're talking of impact of change in technology on capital budgeting decision. Now, when we say that the technology is changing and the impact that it may have on the capital budgeting decision, right? Due to the changes in technology, what is it something that can happen? The market may face a fresh wave of, new technology, new machineries coming in, right? So because of that, the way you produce your product, the cost of producing the product may go significantly down, right? Or maybe even if the cost is not going down, you can expect the quality may be improving due to some improved technology products coming in, right? So whenever there is a change in technology, it can actually alter the production process significantly, right? Whenever there is a change in technology, may improve, better thing in the form of what? Better quality, faster production, flexibility to alter the production, right? Now, of course, due to the change in technology, it can also result in the cost of manufacturing and also the cost of capital. I mean, the way you are going to raise money. when you have access due to technology, when you have access to multiple buyers, multiple lenders, you can compare the rates and then choose appropriate rate for you, right? There is going to be improved cash flows that can be achieved through technological changes, right? So improved cash flows that can be achieved through technological changes. When we say that your cash flows are likely to improve, the product may be of good quality and you're able to sell it at a higher price, right? So when you're able to sell it at a higher price, you can definitely realize a higher rate of return, right? There may be a need also to incur additional cost in the form of additional capital expenditure. So like whatever capital expenditure, whatever budgeting you would have done, you may be required to give some sort of addition to that, right? So due to that, you need to account for also the cash flow that may come in there. Due to technology, your product may change altogether, right? For example, you invested in a factory to manufacture, let's say, LED TVs, right? Now, there are various types of LED TVs, OLED, QLED, ULED. I don't know what sort of LED TVs they're coming up with, all these companies. But suppose there is some technological disruption and you have some innovative product, maybe some innovative version of a projector. So now people are shifting, their preference from a television to a projector. So when such things are happening, that the preference is getting shifted from a television to a projector, there will be disruption. The sales volume is going to be impacted. The sales volume can be impacted as the anticipated life cycle of the product can be shortened, right? So anticipated life cycle of the product can be shortened because of change in the consumer preference. As the consumer preference changes, the lifespan is also going to be changing, right? So the sales volume can be impacted as the anticipated volume is going to be changing. So that impact, when you're making the capital budgeting decision, we need to take into account the risk of such technology, right? So various techniques like we are going to use, we're going to learn all these techniques in going ahead, which is sensitivity, simulation, and scenario analysis. Once the project has been implemented, it's not that you can turn a blind eye to that. You need to be on your toes to evaluate whether it's going in the same line as we have originally thought of. And if there is any negative impact on that, negative impact of any changes, we need to be cautious to handle that situation, right? So if the continuation of project is proved to be unviable, like you started a project, initially you had some good amount of sales, but later then there is no demand. There's no demand for your product. So it of course doesn't make sense to me, to continue with the project. Rather, what we should consider is evaluate an option whether to abandon that project, whether to leave that project in midway. Like it's okay to have a loss of 10 rather than having a loss of 50. So that decision is abandonment decision, which will take it up at a later stage, right? And also, if you are in an industry, which is subject to technological disruption, if you are in an industry which is subject to some sort of technological disruption, then you need to be using a higher rate of discounting, right? You need to be using higher rate of discounting. So that's going to be like, we need to use a suitable discount rate. Okay. The other impact will be with regards to government policies, right? Now, what sort of government policies? When I'm talking about government policies, it includes the holistic governance, right? Right from your central to state to even the monetary authorities like RBI, SEBI, and all, right? So, any changes, government's policy, be it their fiscal policy or monetary policy, that can definitely have an impact, right? That can definitely have an impact on our cost of capital, right? Because, one second, I think the loss of network. So when there is a changes in the monetary policy of government, like let's say RBI, raises the rate of interest, the cost of capital for you is also going to increase, right? And if you have invested in certain financial project, then when you're calculating the PV, when you're calculating the NPV, that's where your numbers may go other way around, right? So cost of debt is normally dependent on the bank rate, as they're considered one of the important factors to compute the YT. Fiscal policy, if the government is changing fiscal policy in the form of additional taxes or reduction in taxes, any of the tax rates are changed, or the rate of depreciation which government allows for taxation, that is going to have an impact on our NPV. So when we are calculating the projects which are having cross-border activity, there the government actions with regards to forex is also going to play a role. So I need to be alert what is the rate change happening in the market, and accordingly maybe I'll have to recompute the NPV, maybe I'll have to do some sort of differential financing strategy by which I'll be able to reduce my cost of capital. Okay, so when we are looking at this aspect, we are definitely going to make a decision under uncertainty, decision which will involve some amount of risk, right? So decision making something which are, if it is a certain scenario, then there's no problem at all. But when it comes to like there is some sort of risk involved in it, the value may vary, or what cash flows you're going to get, that is subject to uncertainty. If that is subject to uncertainty, how do we deal with that? That's what we are going to look at. So right now, let me just look into that initial aspect of statistical factor. So I'm going to discuss about the statistical factors that we use when we are evaluating the capital project. So there are, of course, industry-specific factors and other aspects also. So we are looking at the statistical techniques initially right now. Okay. So let me take some examples for us to understand what are these statistical techniques. And of course, we'll take up some numericals also for that. Now, some statistical tools that we are going to use, if you can just recall, something called as expected value. Do you remember this? Expected value in our foundations.
Yes, sir, by using the probabilities.
Yes. Then we're going to look at what is variance. This is like variance in expected values.
Yes, sir. Variance is putting the square root of that deviation.
Then variance, after variance, you might have also learned called as standard deviation.
Standard deviation.
Values, right?
Then coefficient of variance.
Standard deviation in the expected values. Right? And then we have the coefficient of variance. So coefficient of variation. Expected value, variance in expected values, standard deviation is expected values, and the coefficient of variation. Okay. Now, when we're talking of these expected value, variance in expected value, standard deviation, coefficient of variation, we are going to think of, some statistical number, right? So before I go into the project, let me just consider a share price of a particular company. Let's say price of a share of a company will depend on what economic scenarios are coming up, right? So if we say that there are multiple scenarios, right? So scenario number 1, scenario number 2, scenario number 3, scenario number 4, and scenario number 5. Let's say 5 scenarios are possible. And we say that market price of the share may vary. Right? So market price of the share, we're saying it can be, if the scenario is very good, then the market price will be 500. If the scenario is going to be okayish, then 400. Worse than that, 350, then 300, and 250. Market price per share is 250. Okay, so price of the share, we have market price 500, 400, 350, 300, and 250. And then we talk of probability. So probabilities are 0.5, 0.2, 0.1, 0.15, and 0.05. These are the probabilities. Okay. And we know sum of all probabilities is going to be 1. Now, when I want to say what is the expected market price, how much are we going to expect? How much, what's the price that we are expecting for the share price to prevail? Expected market price. So it's going to be like, when we're talking of expected market price, it's simply like 500 market price per share into probability. So basically, I can expect the price to be 500 to 250, but what I'm going to expect is somewhere in between. Somewhere in between, when we say we're talking of market price per share numbers, we multiply it by the probability. We simply take the weighted average essentially. So expected market price is simply going to be summation of probability into market price per share. Right? Probability into market price per share. So we can definitely do this probability into market price per share and then take the total. Probability into market price per share, take the total. Yep.
It's 422.5.
Okay, so that's 422.5, everyone. So the expected market price is 422.5. Now, with this expected market price, am I sure that the market price is going to be 422.5, or is it subject to some amount of change that is possible?
Yeah, change is possible, sir.
Change is possible. The values may vary. Am I right? The values may vary. So how much is the variation going to be in the values, right? So we're talking of deviation from mean. So basically market price per share minus, this is, we are going to represent it as average of market price, some sort of average. So market price per share minus market price per share average. And then you take the total. Just do this average. I mean, take the difference. 500 minus 422.5, 400 minus 422.5, 350 minus 422.5, 300 minus 422.5, and 250 minus 422.5. Do the subtraction and give me the total, guys. Give me the total, guys.
It's coming minus 267.5.
Minus 267.5. Is it? Others? Can anyone else just verify? Okay, anyways, so if you would have already got these numbers, that is MPS minus average MPS, you know what? I cannot take this number into consideration for checking the deviation. I mean, whatever is the variation, whatever is the up and low happening, I cannot rely on this number. Why can't I rely? Tell me.
Because there is a negativity in it.
No, not negativity. Because you have not encountered for the probability. So 50% chance is that the market price is going to be 500. So have you encountered that probability in the calculation over here, or have you just considered the difference between these two? We've just considered the difference between these two, right? So the difference in the first value and the difference that you observe in the second value, are they having the same weightage? Are they having
No,
the same
sir.
weightage? No.
No, sir.
How
Weightage
can
is
I
different.
add all of them together, right? Can I add all of
Yes.
them together?
No, sir.
No, we can't add them because there is a different probability or different weightage, different importance given to each of those values. So what we need to do is, essentially, let's consider the weightage also into it. So what you do is probability into market price per share minus average of market price per share. Probability into market price per share minus average of market price per share. Okay. Probability into market price per share minus average of market price per share. Let's take a total of it. So you would have already calculated these numbers. So just multiply them with the probability and then take the total and give me the value. Give me the value, guys. Take the total and tell me what's the number. Yep. What's the total? Are we getting the total to be 0?
Yes, sir.
Yes. So
Yeah.
if it is 0, can we really conclude, that there is no variation? Now, of course, we can't conclude it, right? Now, the only reason we observe that this value, I want the reason from you. Can you tell me why is this value coming out to be 0? Why is this value coming out to be 0? Can anyone tell me why the value is coming out to be 0? What could be the reason? Why is the value coming out to be 0? What is the reason? It's simple. You might observe that in MPS minus average of MPS, there are some values which are positive, some values which are negative. Am I right? There
Yes,
are some
sir.
values which are positive, some values are negative, and they are offsetting each other. So when I adjust it with probability, they exactly offset each other, and you get the value to be 0. Now, of course, it doesn't mean that there is no deviation. So how do I get it corrected? The only way to get it corrected is simply, the only way to get it corrected is, simply going to be like MPS minus average of MPS. You take the square of this. So once you take the square of this portion, all the negative numbers will become positive. So you have only positive deviation square and there's no negative number now. So for that, we'll just add one more column. We'll say price into MPS minus average of MPS square. Right? So we get the total of this. Now, how do we get this number? Price into MPS minus MPS average square. For that, we already know that it is price into MPS minus MPS bar is done. Now, for this, what we need to do is just multiply this with this. So just multiply both of them because you already have price into something. You want price into that something square. So just multiply this number with this number. You will get the value over here. So for example, the first value, MPS minus MPS bar, I think it is 77.5. And when you adjust it with probability, it should be 38.75. So price into MPS minus MPS square, because we're trying to take the square of it, we just need to multiply both of them. So essentially it's going to be 77.5 into 38.75. So that's 3003.
Yes, sir. It's coming 3003.
3003.125. Okay. Now, same way, you just do the multiplication throughout and then give me this final number. Just give me this final number.
Sir, final number is 7,367.
7,367. Just check, guys. Just check whether this is correct. 7,367. Just check. Is it sorry, I wrote it as what? 3367, not 3367. This 7,367.
Yeah, 7367.
7367. Okay, fine. So we got this particular number. Now, when I want to say what is the variance of market price per share. Variance of market price per share is, it is called to be squared deviation. This is going to be summation of squared deviation. So whatever is deviation, having the square term of it, this coming out to be 7367. Now, for all interpretation purpose, this number has nothing to do. We can't interpret anything from this because it's just a squared deviation. So if I want a number to be more interpretable, like over here, we have already squared it. So squared term cannot be interpreted. So if I want a number wherein I want to know how much it can go up or how much it can come down, for that we calculate something called as standard deviation. So standard deviation of market price per share. Can you tell me how do you compute the standard deviation?
It's a square root of, it's a square root of variance.
Yes, it's square root of variance. Okay, so square root of variance is going to be square root of 7367.
It's coming 85.83.
85.83. So standard deviation of market price per share is 85.83. Right? Now, this 85.83 is a useful term because when we say 85.83, it essentially means that the market price may go up by 85.83 or it may come down by 85.83 from this 42.5. Or again say 422.5 has got two sides, right? So on a higher side, it can go up by 85.83 or it can come down by 85.83. So market price is expected to be somewhere in that range. If we assume it to be like equally likely on both sides, it may be going up. It's likely to go up by 85.83 and can come down by 85.83 on an average basis. Okay. Now, of course, by looking at this 85.83, by merely looking at this 85.83, I can't be sure what is the proportion of deviation going to be, by how much is going to be the variation, whether how much portion it can go up, how much portion it can come down. So for that, we'll talk of coefficient of variation. Coefficient of variation is standard deviation upon
divided by NPV, expected value.
Right. So coefficient of standard deviation is like we are saying that the price may go up or come down by 85.83. It can go up or it can come down by an amount of 85.83 and from a value of 422.5. So the 422.5 can go up or it can come down by 85.83. So, I mean, what's the number over here? If we divide this,
it's 0.20.
85.83 divided by 422.5, which is 20.31%. Okay, so 20.31 or 20.32%, that's the coefficient of variation. 20.31%, 20.32%, that's the coefficient of variation. Okay. Right, so 20.31, 20.32, whatever it is, that's the coefficient of variation. Now, that is something which you'll be able to compare with other companies' market price. Because other companies, like for example, if our prices are in 3 digits, ranging from 250 to 500, if there is some other company which is having a price in the range of, let's say, 2,000 to 3,000, obviously their standard deviation is going to be a larger number, right? So I cannot compare standard deviation of one entity with standard deviation of another entity. If I want to compare them, then it has to be by way of coefficient of variation. Then it has to be by way of coefficient of variation only. Okay, so coefficient of variation is going to be used for comparison between the projects. Fine. Everyone?
Yes, sir. Fine, sir.
Yeah. Okay. Now, let me just give you some outline maybe for another 10 minutes, and then we'll take a break after that. Okay, and then come back with more discussion. So in my session, I generally take break at the end, wherein we just have the last around 30-40 minutes left. Okay, so that goes at a bit faster pace. Okay, now let's say we are calculating NPV of a project. Okay, so we have a project A data available with us. Right? So we'll first analyze project A, and then we'll go for project B, and then we'll definitely think of how do we go about the other aspect. Okay. Now let's say project A, we're saying that year 0 and then year 1 to 5. There are 2 situations or 3 situations rather possible. Good, normal, or worse. In good situation, rather in all the situations, there's going to be an investment of 5 lakh. Okay. Year 1 to 5, it's going to be 6 lakh, 4 lakh, and 2 lakh. Okay, so every year these are the cash flows that we expect. Can you tell me what will be the NPV, let's say at a cost of capital of suppose at one second. 7%, let's say. So let's say you give me the NPV for all the 3 situations at 7%. So at a rate of 7%, can you calculate the NPV in all the situations? Good, normal, as well as worse. Can we calculate the NPV? Like I'll just do the calculation for good one. You can just do the normal and worst thing. So NPV is simply going to be 6 lakh into present value annuity factor minus 5 lakh, which is 6 lakh into what's the present value annuity factor at 7%, guys?
4.10.
4.10. 4.10 minus 5 lakh. Yeah, so this totals to
Sir, it's coming 24 lakh 60,000 minus 6 lakhs. Sorry, 5 lakhs. 19 lakh 60,000.
19 lakh 60,000, right?
Yes, sir.
19 lakh 60,000. Same way, give me the NPV in normal situation and in worst situation. Give me the NPV in normal situation and worst situation.
Sir, normal situation is 11 lakh 40,000.
Worst situation, 11 lakh
40,000.
40,000. Okay. And in the worst situation,
Worst situation is 3 lakh 20,000.
3 lakh 20,000. Perfect. Now, if I tell you that 19,60,000 is having a probability of 30%. This is having a probability of 0.4, and this is having a probability of 0.3. Can you calculate the expected NPV and the standard deviation now from this?
0.354.3.
Yes or no?
Yes, sir, we can create it.
So we'll do simply like this: probability NPV. Probability is 0.3, 0.4, 0.3. NPV is 19,60,000, 11,40,000, and 3,20,000. Now to calculate the expected NPV, what we simply do is probability into NPV, and then NPV minus expected NPV, right? And then you do probability into NPV minus expected NPV square. You take this and get the expected NPV here, and then it's the, you just take a total, and then give me the standard deviation and the expected values. So calculate these values. Calculate the expected value and the standard deviation in this case. So we have got 3 NPV scenarios. Yep. Check what's the expected NPV and then the standard deviation and the variance. Expected NPV, guys. Second value is 456,032. Then 96012. Expected value is 1140080. 11,40,080. Then standard deviation, calculate the standard deviation. Summation, square root of summation of P into probability into NPV minus expected NPV square.
So standard deviation is coming around 1,54,919.
Standard deviation is
154,919.
34919. Doesn't seem to be. Standard deviation should be 6,35,000 approx. 6,35,000 approx. $3,000. 6,000. So expected value 588,036. 88036 plus 4,56,000 plus 96012. 11 lakh 3,048. Yeah. So approx 6,35,000 should be the value of standard deviation. Yeah, you can just get it checked. Then let me just give you, this should be the answer. Also, I'll give you one more case. Let us say year. And in that, we are again going to give you, let's say, good, normal, and worst situation, year 0, and then 1 to 5. The cash flows are like 5 lakh initial investment, and you get 5 lakh every year. In normal situation, you invest 5 lakh, you get 4 lakh every year. And in the worst situation, let's say you invest 5 lakh and you get 3 lakh every year. Okay. Here also get the expected NPV and standard deviation. Okay. So this is a part of your self activity. Right now, let's just take a break of approx 10 minutes. Post that, you can just come back and start solving this particular question. Okay. So for that, I'll give you another 10 minutes. And then after that, we will start, we'll discuss this answer and then proceed with the next one. Okay. So let's take a break now, guys. Rate for NPV, same 7%. Okay. So discount rate is same 7%. Okay. And okay, this probability I'm talking of over here, the probability is 0.3. Here the probability is 0.4 and the worst situation probability is 0.3. Okay, the same set of probabilities we're talking of 0.3, 0.4 and 5. Okay. Fine. So let's just take a break over here. So we'll meet back at what to discuss at 9:35. Okay, so you have got 10 minutes. Post that you have to solve this question and then we'll take it forward in the next continuation. Okay, so let's take a break, guys. the expected NPV and standard deviation for this case? Yep. So what's the expected NPV here in the second case? Yeah, guys. So expected NPV will be 114,080. So in first situation, it's 155. In second situation, 114,080, and worse it is 317,600. So expected NPV is 114,080. Correct?
Sir, I'm not getting how that 80 is coming. That first case is the NPV is 15,50,000. Second is 11,40,000. Third is 7,30,000.
Correct.
Yeah, when I am multiplying with the probability 0.3, 0.4, 0.3, it's coming
Normal.
whole. Yeah.
NPV in case of good, it is 1,55,100.
No.
114,080.
Okay. Because of the rounding of that in annuity, that's a problem, I believe.
So in worst situation, it is 73060. So you get the expected NPV.
11,40,000 for me.
11,40,000. Okay. Approx coming up to be on the similar lines. And what about the standard deviation? Standard deviation 3,17,600 approx. Yeah.
So actually, the decimal is high because when the squaring of it's coming around the 12 digit.
Numbers will be very large. So
Yeah, it should be very minimum at least.
you can solve it in other way around. Like if it is lakhs, you can just give the heading as in lakhs, and then finally, once you get the standard deviation, you multiply it by 1 lakh. That way also you can do. Okay, so standard deviation should be 3,17,600 guys.
But both the expected NPV is same.
Yeah, expected NPV is same, but the variance or standard deviation is different. So, of course, we can say the second project is second project is less risky. Okay. Fine. So now this expected cash flow or variance of cash flow that we said, we've already covered that aspect. Now, let's say we are going for the Yeah, question number 3. So possible net cash flows of project A and B at the end of first year, and their probabilities are given below. Discount rate is 10%. For both projects, initial investment is 10,000. Calculate the expected net present value for each project. State which project is preferable. So possible event A, B, C, D. There are 4 events, and these are the cash flows given to us. We have to calculate the expected NPV, just the expected NPV, and then we have to say which project is feasible. So it's pretty easy because we just need to take the probability and the cash flows. Then what we do is multiply probability with cash flows. So probability is 0.1, 0.2, 0.4, 0.2. Cash flows are 8,000, 10,000, 12,000, 14,000. We can definitely multiply the cash flows with the probabilities, right? And we say that end of first year. So these are all the cash flows that we are expecting in the end of first year. So we can get the expected cash flow in year 1. So take the total of what? Take the total of probability into cash flows. Total of probability into cash flows.
Yes, sir. For that,
How much it is?
yeah, project A is 10,400. Project B is 15,200.
I think there is, oh, we missed it, this part. This is also there. Sorry.
Okay, then I need to add it.
I also missed that part.
Okay.
Yeah. So we need to have the event E also with the probability of 0.1, because if you add the probabilities, that should be 1. That's not in the early case. This is with a cash flow of 16,000. So what's the expected cash flow?
Yes, first case is 12,000.
Yes, it is 12,000. Okay. For second case, again, we have a different set of probabilities and the cash flows.
800.
And simply say probability into cash flows. So probability is 0.1, 0.15, 0.50, 0.15, and 0.10. Cash flow is 24,000, 20,000, 16,000, 12,000, 8,000, and take a total.
It's coming 16,000, sir.
So this is 16,000.
Yes, sir.
Okay. So A and B. We know the expected cash flow in year 1. So year 1 mein A ka it is 12,000, B ka it is 16,000. Now, what is the present value of expected cash flow? EV of expected cash flow kya hoga?
It's a 10%. 10%.
Yeah, this is A, this is B. So we can say A into PV factor at 10%, so 0.9091.
Yes, sir. It's coming 10,909.
10,909.
Yes, sir. The B 14,545.
14,544. Perfect. Then from this, we are going to reduce
Initial
the
outlay.
investment amount. So the initial investment amount was 10,000. In fact, both were having initial investment of 10,000 only.
Yes, sir.
So we get the NPV 908 and 4544.
Yes, sir.
Okay.
This is pretty simple.
It's pretty simple. It's just a straightforward thing. Now let's look at the fourth question. The fourth question, we have 3 years data. Calculate the expected net present value of project using 10% discount rate if the initial investment of the project is 10,000. So probabilities for net cash flows for 3 years are given. Year 1, 2, 3. You have the cash flow and the probability is given. Okay. So first we need to get the expected cash flow in each of the years. So can you tell me here and the expected cash flow? So year 1, 2, and 3. We have got 3 years. So you can just multiply them and give me the expected cash flows. The expected cash flow can be simply obtained by multiplying cash flow with the probability. Right? So just multiply the cash flow with the probability, like 2,000 into 0.1, 4,000 into 0.2, 6,000 into 0.3, 8,000 into 0.4, and give me the total value over here. What's the expected cash flow for the first year? Well, I can simply do this as over here also writing 2,000 into 0.1 plus 4,000 into 0.2 plus 6,000 into 0.3 plus 8,000 into 0.4. Second year it is 2,000 into 0.2 plus 4,000 into 0.3 plus 6,000 into 0.4 plus 8,000 into 0.1. Then it is 2,000 into 0.3 plus 4,000 into 0.4 plus 6,000 into 0.2 plus 8,000 into 0.1. What are the expected cash flows, guys? Tell me. Expected cash flow for the first year. Expected cash flow in the first year, guys. What's the number?
So it's coming 6,000.
6,000. Okay.
Second year 4,800.
Second year 4,800.
Third year 4,200.
Third year 4,200. Perfect. Now we have to get the NPV of this. So calculation of expected NPV. Here expected cash flows, present value factor and present value. So here was 0, 1, 2, 3. 10,000 is the investment that we are going to make, right? And first year it is 6,000 expected, second year 4,800, third year 4,200. So we have to take the PV at 10%. So present value factor at 10%, take the total of PVs.
So NPV is 2,577.
Okay, just check, guys, where it is 2,577. Check whether it is 2,577, guys. Yep. You're getting this? 2,577 NPV. Yes, everyone? Okay, fine. So let me just open up to you if you have any queries regarding the today's session. Any queries, any questions, guys, regarding the today's session? Let me check whether there is any questions on the portal.
Bandhuji, I think there is only one student has asked that in the beginning he has mentioned that WAC.
So that is answered.
That is the answer that you have
That
asked
is
in the
answered.
beginning, na?
That is done.
While discount. Yes, yes.
Any queries, guys? Because we have like covered quite a good number of concepts today. First, we did the inflation adjustment, and then we have also started with the risk part, wherein we computed the expected values and also the standard deviation variance, and the coefficient of variation. Right. So we have done approx, I think, 4 questions on that. We still have around a couple of more questions to discuss that in detail, which will be definitely surely taking up in the upcoming sessions, and also going ahead with substantial amount of other discussion also. So if you guys have any queries right now, you can put it forth. Queries?
Okay, I think no. So you, in the next class you will continue this topic, or you will start next topic?
No, it will continue. This will continue.
Okay. Okay, student, if you don't have any query, Bandhuji, just write down our email ID.
Yeah.
This is sfm-final @ICAI.in and 0120 3045 956. Okay, this phone number. Okay, student, I think the session is going to be over. Only there is one thing I want to discuss with you. I think Bandhuji, when you were discussing, I think first question you was discussing. So just can you take the slide upward just little bit? Just you have started, I think first question you have started, I think assignment, where you were showing this, where you were rounding it off. The value was somewhere coming. Okay, just above it. Yeah, I think, or just or more about it, or I think it was an assignment question where you were mentioning that you were rounding it off. Somewhat you were rounding it off. So, okay, just more.
Selling price was rounding it up.
Yeah. The selling price was rounding off. So this was, yeah. So somewhere students may be confused, like, sir, up to how many decimal point we can take this value. Now, student, generally, if any instruction have been given in the examination, you follow the same. Otherwise, you have to see the logic behind it. Generally, selling price of any product generally comes into up to 2 decimal points only. Okay, similarly, when we will discuss the topic of security valuation, there also the price of the shares are generally quoted as up to 2 decimal points only. So that you have to apply some logic as well. So, okay, Bandhuji, that I want to discuss with the students.
Sir, then I have one more query. And when you are discounting the discount rate, up to how many decimal we can take it?
Yeah, Samanathan, as I told you in last class, if any discounting factor has been given you in the examination, you follow the same. Otherwise, up to 3 decimal point is a good practice. 3 or 4. 3 or 4. Okay, because see what happens in generally when we use the 4 decimal point. Okay, 2 decimal point. So what happens when we are using the figures of crores? So it matters a lot. 0.00 to after 20, if any value is there, then it matters a lot. So 3 or 4 decimal point is okay if you are using nothing has been given.
Okay, fine, sir. Then one more query.
Yeah.
In how many more classes for the advanced capital budgeting? Today is one class. How many more are there?
Somewhere around we budget for this
2 more
class.
sessions, sir.
No, for
There
this
are 2 more sessions.
advanced capital budgeting he is asking, na? Or
Yeah,
you
advanced
asking,
capital, 2
okay,
more
advanced
sessions.
2 more sessions.
Okay, sir, fine. Totally 3 class.
Totally 3 class. I thought you are asking about AF, advanced financial management.
No. Only I am asking for the advanced capital budgeting
Only
alone.
2 more classes are there. If required, we can arrange the more. Don't worry about the classes. Number of classes are don't worry about the same. If something is left, then we cover it. We will not left any topic untouched. Don't worry about the same.
Right, sir. Thank you. It's my pleasure.
Okay. Okay, student. With this, we come to the end of this session, and we thank you, Jagbandhu sir, for sparing his precious time and enlightening the student on the same topic. Now, student, we shall continue this topic in the next class. So, Jagbandhu sir will cover this topic again on this topic. We shall continue this topic. So, please, my request to you, please revise whatever had discussed in today's class, and you can ask before beginning the class or during the class. Better it is you ask about the previous class in the next class. So, in the next class, you prepare. Revise whatever has done in today's class, and if any doubt, ask in next class. Thank you, students, for patience, and thank you, Divas sir. Thank you, Jagbandhu sir. Thanks a lot, sir.
Thank you, sir.
Okay. हाँ, बस एक आध मिनट देख लेते हैं, अगर बच्चे का कोई चैट वैट में कुछ आता है तो पकड़ देते हैं, नहीं तो चलिए कर दीजिए ओवर. थैंक यू.